If you're a long-only investor and you have a team of people who are trained only to be long investors, you only look for great things. You only look for things that go up. You only look for things with earnings growth. You only look for things with wonderful management who are very impressionable, who have these great ability to explain a story to you. And what you might miss along the way in looking for that next compounder in your portfolio is the fact that the financial statements might be erroneous. There could be some red flags appearing that you ignore because you're so enamored by the quality of the CEO and the management team. You might miss that there's some strategic insider selling. You might miss that the second-tier accountant has stayed on too long. These are all things that you can miss if you're long biased and you have not trained yourself to spend some time looking for deception, looking for questionable accounting activity, looking for egregious management behaviour, corporate malfeasance. These are things that you need to teach yourself to do, and particularly teach your analysts and your team who work with you to try and detect. And it's very powerful when everybody on your research team spends time looking for shorts and looking for the negatives, looking for what can go wrong. It's like the Google engineers who get their own time, 10 to 20% of their own time, do their own projects. They're better programmers as a result. And we're better investors because everyone on our 9-person investment team spends their time looking for shorts. It makes us better investors. So we think it's a very powerful tool in our toolkit. It allows us to make money regardless of the direction of the market. Most people in a downward trending market who are long only have cash, and generally speaking, most long biased investors tend not to hold much cash. They're long the market and they can't do much. Well, in a volatile environment or a downward trending market, which we certainly had 8 to 9 years ago, you can actually make money as a short seller. And in a non-directional market, which is really a flattish market, that's when you can really make money as a short seller. So it allows you to pick up return in companies of questionable quality. And we like we like accounting frauds and frauds in general. Usually it starts with accounting. We like shorting fads, and we like shorting industry disruption. And we particularly love it when we get one of those three and a fair bit of debt. And you put it all together and you get quite a good outcome. But we need a catalyst. So shorting, we gravitate towards it because we think it makes us better long investors, but we also think it helps accentuate the return in our portfolio.